If I had to react to this earnings night from scratch, knowing what I know about big tech, AI spending, cloud demand, and how fast this market punishes anything that sounds expensive, I would not begin with one stock being green and another stock being red. I would begin with the real question. Are these companies still buying the future, or are they starting to overpay for it? Because most people look at earnings like a scoreboard. Revenue beat, earnings beat, stock up, stock down, easy. But that is not the market we are in anymore. We are in a market where the biggest companies on earth can report strong numbers and still get sold, because investors are no longer impressed by the word AI alone. They want proof. They want monetization. They want to know that all these data centers, chips, cloud contracts, agents, copilots, models, and infrastructure projects are not just a very expensive way to keep up appearances. Today is Thursday, April 30th, New York time. Comment below what day and date you are watching from, because with earnings like these, the first reaction and the real reaction can be two completely different things. And if you value this type of work, support the channel by subscribing and comment John A.G. Best, so I know you are part of the real audience here. Now, this was not just another earnings night. This was a test for the AI trade. Alphabet, Meta, Amazon, and Microsoft all gave the market fresh numbers, and each one told a different story. Same theme, different problem. Alphabet gave investors the cleanest answer. Meta gave investors a spending headache. Amazon gave investors a strong business with a heavy cash bill. Microsoft gave investors great cloud numbers, but still left them asking about the payoff window. So let's walk through this slowly, because the point is not who won the first 10 minutes after the close. The point is what these reports say about the next phase of this market. Alphabet looked like the easiest one to understand. The company showed strong overall growth, Google services moved higher, YouTube ads grew at a healthy clip, and Google Cloud accelerated hard. Based on recently published numbers, Alphabet revenue rose a little over 20%, Google Cloud jumped more than 60%, backlog nearly doubled, and paid subscriptions reached roughly 350 million, led by YouTube and Google One. The company also raised its quarterly dividend slightly, which tells investors it can spend heavily and still return cash. That matters, because the market does not just want AI stories now, it wants evidence that AI is flowing into real businesses. Cloud backlog is one of those clues. When backlog rises, it means customers are not just testing a chatbot for fun, they are committing money. And that is why Alphabet got rewarded. But do not make the mistake of thinking this report ended every debate. It did not. Alphabet still has the search problem hanging over it. If AI answers become the front door of the internet, what happens to traditional search advertising over time? Maybe Alphabet protects it. Maybe AI makes search even stronger. But maybe margins get squeezed because answering questions with models costs more than serving links. That is the tension. So Alphabet won the night, but the bigger story is not just that Alphabet beat. It is that Alphabet showed investors a believable bridge from AI spending to revenue. Meta did not get that same grace. And this is where earnings get interesting, because Meta's headline numbers were not bad. Actually, they were strong. Revenue grew fast. Earnings looked big. The advertising machine still worked. Users were still there. The company was not falling apart. But the stock dropped because the market looked past the headline and saw the bill. Meta raised its spending outlook again. We are talking about a capital spending range that now stretches from the low 100 billions into the mid 100 billions. That is an enormous number, even for Meta. And the reason investors flinched is simple. Spending can be bullish if it creates future revenue. Spending can be dangerous if the return stays vague. There was also an earnings quality issue. Meta's reported profit included a little over $8 billion of tax benefit. Without that benefit, earnings would still have been solid, but they would have looked much less dramatic. In other words, the beat was real, but not as clean as the headline made it feel. Meta also said capital expenditures were driven by servers, data centers, and network infrastructure, which is basically the physical foundation of the AI push. Now, to be fair, there is another side to this. Meta may be spending aggressively because demand is real. The company has already used AI to improve recommendations, ads, content ranking, and engagement. If that keeps working, then investors might look back and say the spending was painful but necessary. But the market is not patient forever, and that is the shift. A year ago, bigger AI spending often sounded exciting. Now, bigger AI spending can also sound like margin pressure. Same spending, different market mood. That is important. Because if you are watching Meta, the question is not, did they beat this quarter? The question is, can they prove that every new layer of AI infrastructure creates more revenue, better engagement, and stronger ad pricing fast enough to justify the scale of investment? Until that answer gets clearer, Meta can be a strong company with a stock that still gets pushed around. Now, Amazon gave us another version of the same story. Amazon's results were strong. Net sales climbed. AWS accelerated to its fastest growth pace in many quarters. Operating income improved. Earnings were much better than last year. Advertising kept scaling, and management pointed to strong demand across cloud, chips, stores, delivery speed, and AI services. Free cash flow, however, collapsed compared with last year because property and equipment spending surged, mainly for artificial intelligence investments. That one sentence explains the whole Amazon reaction. The business is strong. The spending is massive. Both can be true. Amazon is becoming harder to value because it is no longer just the everything store. It is a cloud company, an advertising company, a logistics company, a streaming company, a chip company, and an AI infrastructure company all at once. So when AWS grows quickly, cloud investors get excited. When free cash flow drops, cash flow investors get nervous. When advertising grows, margin bulls smile. When capex keeps climbing, valuation people start sharpening pencils. That is why the stock can wobble even when the report looks good. And here is the fresh angle most people miss. The AI build-out is no longer just about buying GPUs. It is about power, land, cooling, networking, custom chips, fiber, memory, transformers, construction schedules, and long-term customer commitments. These companies are not buying a software license. They are building industrial infrastructure. That means the payoff will not always show up neatly in one quarter. Amazon may be doing the right thing, but the market is asking whether the right thing costs too much in the short run. That is a very different debate. Then we have Microsoft. Microsoft is probably the cleanest example of good is not good enough. The company reported revenue of a little under $83 billion, operating income growth around 20%, net income growth above 20%, and diluted earnings per share above $4. Azure and other cloud services grew around 40%, and Microsoft Cloud revenue reached the mid-50 billions. Those are not weak numbers. Those are monster numbers for a company this size. But the market still wanted more. Why? Because Microsoft has become one of the central proof points for enterprise AI. Investors are not only asking whether Azure is growing. They are asking whether Copilot is becoming a must-have product, whether companies are paying for it at scale, and whether AI agents are turning into real revenue streams. On that front, there were important details. Microsoft said paid Microsoft 365 Copilot seats are now above 20 million, with strong year-over-year seat growth, and that major customers are committing to very large deployments. It also talked about agents, usage intensity, custom workflows, and consumption-based offers. That is not nothing. But again, the market has moved from imagination to measurement. Investors want to know how many users keep paying. They want to know average revenue per user. They want to know how much compute cost sits behind every AI interaction. They want to know whether Copilot lifts margins or just adds another expensive layer to the software stack. And then there is the OpenAI relationship. Microsoft still talks confidently about the partnership and its model choices, including OpenAI, Anthropic, and open source models. But investors are right to ask whether the future is exclusive enough, profitable enough, and predictable enough. If the AI ecosystem becomes more open and multi-model, Microsoft can still win, but the market will not value that story the same way it valued a simple one-partner narrative. So Microsoft's report was strong, but the question was sharper than the answer. Now, what does all this mean for Nvidia? This is the part where the whole night comes together. If these companies were cutting capex, slowing cloud buildouts, or talking about weaker AI demand, that would be a problem. That would hit the whole infrastructure chain. But that is not what we saw. We saw Alphabet accelerating cloud. We saw Meta raising infrastructure spending. We saw Amazon pouring money into AI capacity while AWS re-accelerated. We saw Microsoft saying cloud and AI demand remain strong. That is supportive for Nvidia, AMD, networking companies, memory suppliers, power equipment providers, cooling systems, and data center construction. But it also raises the standard. The market will now ask which suppliers have real pricing power and which ones get squeezed once supply catches up. That is why Intel suddenly matters again. Intel's report showed revenue growth in the mid-single digits, and management tied the next wave of AI to inference and agentic workloads that increase the need for CPUs, wafers, and advanced packaging. That is an important shift because if AI workloads move from training giant models to running agents everywhere, CPUs become more relevant again. But be careful. A stock can have a real story and still be dangerous after a giant move. Intel has to prove execution, not just benefit from a shortage narrative. It has to show customers, margins, manufacturing progress, and durable demand. A comeback is not a comeback because the chart exploded. It becomes a comeback when the business keeps confirming it. That is the difference. Visa gave us a completely different signal. Visa's latest numbers showed revenue growth in the high teens, strong payments volume, strong cross-border trends, and resilient consumer spending. That tells you the American consumer is still spending, even if people are complaining about prices, debt, rent, and interest rates. And that matters because if the consumer were collapsing, Amazon's retail story, ad spending, fintech growth, and even parts of cloud demand would eventually feel it. The consumer is stretched, yes, but stretched is not the same as broken. SoFi is the cautionary tale. SoFi posted record revenue, 10th consecutive GAAP profitability, net income of around $167 million, membership around 14.7 million, and record loan originations. But shares still dropped because management kept the full-year outlook steady, and investors wanted more after the run-up. That is brutal, but it is also honest. In this market, meeting expectations is not always enough, especially for growth stocks. If investors are paying for acceleration, stability can feel like disappointment. One more thing matters here. Do not treat every AI dollar the same. A dollar spent on a data center that is already contracted is different from a dollar spent because management is afraid to fall behind. A dollar tied to existing cloud customers is different from a dollar tied to an unproven consumer app. And a dollar that improves ad targeting today is different from a dollar that might create a product 3 years from now. That is why the next few quarters are so important. The market will stop rewarding the category and start rewarding the execution. It will ask who has the customers, who has the margins, who has the power access, who has the chips, who has the software distribution, and who can actually turn usage into cash. That is where the winners separate. And honestly, that is healthier. Hype can lift everything for a while, but cash flow eventually sorts the room. The companies that can spend and earn at the same time will keep leadership. The companies that only spend will need forgiveness, very, very quickly indeed now. So what is the real message from this earnings day? It is not that AI is dead. It is not that big tech is broken. It is not that every dip is a buy. The real message is that the AI trade is entering its adult phase. The hype phase was easy. The proof phase is harder. Now the market wants evidence that spending creates revenue, that revenue creates profit, and that profit arrives before investors get tired of funding the build-out. Alphabet gave the cleanest proof. Meta gave the biggest spending anxiety. Amazon gave a strong report with a cash flow question. Microsoft gave great numbers with a monetization question. Nvidia gets support, but also pressure. Intel gets attention, but still needs execution. Visa says the consumer is alive. Sophie says expectations can crush even improving companies. So do not just look at the color of the candle. Look at what the candle is reacting to. A red move after earnings might be fear, or it might be discipline. A green move might be strength, or it might be relief. The first move is often noise. The second and third day can tell you what institutions actually believe. And that is why I would not rush. I would build a watch list. I would separate companies with real demand from companies with only a story. I would watch capex, margins, free cash flow, cloud backlog, AI seats, customer commitments, and guidance. And I would remember that in markets like this, the best companies can still be bad entries if the price already assumes perfection. This is where investors get tested, not when the story is obvious, but when the numbers are strong and the reaction is confusing. That is the market asking you to think. And as always, this is for education and research only. I am not your financial advisor, and this is not a buy or sell signal. Use the information as one piece of your process, check the numbers yourself, understand your own risk, and make decisions that actually fit your plan.